Hello and welcome. My name is Anmol Sinha, and I'm joined today by two of my colleagues, Tiffany Wilding, our U.S. economist, and Scott Mather, CIO for U.S. Core Strategies. Let's get into it. Today we're going to discuss the Fed meeting. So Tiffany, we saw after 3 years and 9 rate hikes, the Fed cut rates for the first time in over a decade. What were the key takeaways for you between the statement and the subsequent press conference?
Well, so I thought the statement was pretty on expectation. I think this rate cut was relatively well telegraphed, as Chair Powell even said in the press conference. So in the statement, we saw the rate cut, as well as I thought, left the door open for potentially more rate cuts by saying, even though we're cutting rates, the risk to the outlook still remains. So that was our expectation going into this meeting. I think where we saw more surprises was actually in the press conference itself. We thought Powell would sort of emphasize this possibility that additional rate cuts could come in the future. We didn't really see him emphasize that. And I think, kind of more broadly, it just reflected the fact that the committee, the FOMC, is pretty divided. And I thought his press conference kind of underscored that. And it is very difficult to communicate on behalf of a committee that's divided. So we saw from June the projections, that about half of the committee actually thought that no cuts at all this year were needed, whereas a pretty large majority thought that 50 basis points of cuts were needed. So clearly, today's statement and press conference was a bit of a compromise between those two camps. But I guess overall, we were a bit surprised that Powell didn't a little bit more forcefully kind of emphasize that we could see more cuts later on this year.
Which makes sense, but maybe some of those challenges in the press conference really led to some unusual market reactions. So maybe we can turn to markets for a second. Scott, of course, the Fed actually cut rates as expected. They announced that the balance sheet unwind would end earlier than expected. And yet you saw the yield curve flatten, the dollar rally, and equities fall. So how would you describe the market reaction?
Well, I think one good way to interpret that market reaction is maybe the markets were a little bit ahead of themselves, or maybe that wasn't the case, but really that there was greater uncertainty. You saw the initial reaction certainly being a deeper equity sell-off. There was a rebound towards the end of the press conference. Same thing, we went from sort of a rally in the bond market to then a sell-off in the bond market, and actually finished with a little bit of a rally in the bond market. So sort of a reversal as we move through the press conference. But I would chalk that up to no big misses, but merely the uncertainties became clear for many investors as that press conference wore on. And
Tiffany, there's been a lot of debate about the factors that are driving the Fed's reaction function. There's, to some extent, are these insurance cuts, or is this a start of a protracted cutting cycle?
Our outlook right now, doesn't call for a recession in our base case. So based on that, we would argue these are insurance rate cuts. On the one hand, we are seeing slowing, and slowing is happening in certain pockets of the U.S. economy that are big enough to cause concern. So Chair Powell today talked about the manufacturing sector, but we're seeing a more broad-based slowing in investment as well as exports. And ultimately, the Fed, what they don't want to happen is they don't want markets to completely lose confidence. You start to see financial conditions tighten. We call this sort of the financial accelerator channel. So you get banks that are pulling back on lending much more quickly, and that accelerates the downturn. I think what they're trying to do with these insurance cuts is really manage the extent to which that happens.
So Scott, investors are naturally trying to wrap their heads around this interest rate environment. On the one hand, growth is softer but still solid, and we don't think a recession is imminent, at least in the near term. And yet you see 10-year yields at 2%. So how is PIMCO thinking about interest rate exposure in portfolios today? Does it still make sense?
Well, we think it still does make sense. I mean, we could view it sort of in the traditional context. It's important to keep in mind, too, that the U.S. is actually the global high yielder. So rates are low everywhere. They're still exceptionally high from a global perspective in the U.S. So there's room for rates to fall further, and we think that it's certainly much more likely that they fall rather than they rise from here. Not only because we're likely to get additional, at least one other cut, or maybe more, but also because when we look at the range of scenarios and outcomes around that, it seems much more likely that at some point in the not too distant future, we'll revisit the zero lower bound again when we get the next true downturn or real growth shock to the U.S. economy. And in that context, 10-year yields probably could go down to new all-time lows, down in the neighborhood of 1% or so. And so there still is the room for high-quality U.S. bonds to provide that income while you wait, but then the potential for another strong capital appreciation episode when we get that shift.
Great. So even if growth normalizes a little bit, 10-year rates can maybe drift a little higher, but not much more room to go. But the risks can look very different. And so maybe I'll ask you a different version of the question. If you think about the risks to our interest rate outlook, do you think we see 1.5% on the 10-year first or 3% on the 10-year?
We think it's much more likely we see 1.5% first than 3%.
Great. Thank you, Tiffany and Scott, for joining us today. And thank you all for joining us.